Let's talk about some, maybe some of the common mistakes that people make on their credit. So I'll bring one up example. Okay,
let's do it.
So someone goes, you know what? I got 3 credit cards. I'm going to go pay them all off and close them all up. So then I can't get into this credit card mess, right? And I should have really good credit because all my credit cards are going to be paid and they're going to be closed.
Mm-hmm. That's a big no-no.
Right?
I can totally understand the thought process behind someone going, you know what? I want to buy a house. I have these credit cards here. I'm going to pay them off and show I don't even need these. I can afford this mortgage with ease.
Right.
I don't need these credit cards anymore. I'm buying a house.
Exactly. And so that I feel is a lot of times what happens. And the thing is, you have to understand that your credit score is all about data. They need data, they need activity data, and they want different types. So you want to show that you have active credit cards.
Yep.
But the key is you want to have them as low balances. You want them active. You want them reporting, but you want low balances, not zero, and definitely not closed. Because when you close them like that, and you lose all that point opportunity now, significant drop in score. So your goal of improving and showing, hey, I can handle this mortgage, now you just went backwards because your risk appears higher, scores go down. You could be denied just for that.
Right. Yeah, it's crazy. And on the insurance side too, Evan, correct me if I'm wrong, but you guys pull credit on insurance side as well?
Yes and no. So there's a score that uses your credit as well as some other things to create one of the aspects of risk rating factors. It's technically not just a credit pull, it's a broader thing. But effectively speaking, yeah, your credit matters for your insurance rates. And it's not just for business insurance. It matters for your homeowners and it matters for your auto.
Yep, 100%.
And then there's another piece to it too, which is people with no credit score. Obviously, if you don't have a credit rating history at all, you're going to struggle to find a loan, but you have to be able to get insurance. So they assume a score, and generally it's like that midpoint, like the rank 3-ish. And that's where you get into these weird things where there's a really rapid fall off after that, because they go, well, we would have assumed that your score was decent, but since it's not, we really have to ramp things up now to compensate for that.
Yep.
Yeah, it's on the same thing on the loan side too. If we can do loans for people with no credit scores. There's different criteria. You got to have more down, and it's like you have all these other factors.
Got to prove the income way out.
Yeah, that type of deal. But then what credit score do we use to run your rate on? Like, because a 620 credit score on a conventional loan and a 750 score on a conventional loan is a huge difference in interest rate. So it's like, well, what score do we use to run it? Well, they assume on the mortgage side of things, they just use the lowest qualifying score. So if it's a conventional loan, the lowest score you can have and qualify for conventional loan is 620. So now we use a 620 score to run your interest rate and stuff on.
That's why I get into a lot of healthy debates with people that apply certain things like the Dave Ramsey type concept, where you don't need credit, you don't need a score. Thing is, you pay more. And the reality is you're working on, and I believe in financial freedom, 100% I do. But most people, when they start entering into that type of concept, they have work to do, right? Well, why? They need to know how to leverage credit to pay less for things, which means you can get out of debt more quickly, and you can still maintain. There's many strategies to maintain a healthy credit score without having to take on that much risk, to kind of go against things. So it's like, the reality is that people need to know credit matters significantly. Do not ignore it. Like, you need to have it, period, if you want what you want.
Yep. No, so another very common thing that comes up is, I got this old collection. Like 3 years ago, I had this stupid, whatever, internet bill that didn't get paid and went to collections. I don't know what's hanging out there, and I've kind of just ignored it. Well, now I want to go buy a house, so I'm just going to go pay that thing off now because I don't want that hanging out, when I go to apply for this mortgage.
Yep.
What happens there?
Another no-no. Major issues there. One is that if you have to think about it like this. Like, if you actually, pull and read your credit report, you're going to notice, like, under a collection, one, there's no like payment terms below it. Doesn't show a history. It's a derogatory debt. It's negative. It's only bad at that point.
Yep.
And what you'll look at is like the last activity date. Well, a lot of times if time has gone by, like you just said, a few years ago, right, the utility bill, that was some sort of dispute and I returned my equipment and they didn't credit me, right? It's usually like an emotional thing that happened, like an event.
Yep.
Thing is, if you go and pay that, now what's happening is you are refreshing the life of that. You're bringing the activity of that from 3 years ago now to today. And in most cases, almost all, when you pay off a collection, does not mean it's removed. It gets updated to zero balance. Now you have refreshed activity on a derogatory debt. It dings your score, scores go down. And a lot of people don't realize too, it's like there's so many things that you can do in advance. Like there's investigation strategies where you could get that removed, then settle. That's a big part of our model is, hey, if we have any sort of collections on there, let's investigate, challenge. There's so many different ways you can challenge reporting history in a way that if they're unable to verify, it's not about validating the debts per se, or, hey, this debt's real or not. It's about the accuracy of the data. That's the key. Vast majority of collection companies cannot do payment for deletion. So that's, me calling saying, hey, if I pay this, will you delete it? Vast majority cannot do that.
Because the other thing, too, is building credit. So not only getting rid of some of the negative stuff that might be in history, but, okay, so now if you get rid of that, but now how do we move forward? How do we build positive credit so that now your score doesn't just stay flatline, now you actually gain points by doing that? So then you have to potentially open new credit accounts.
Yeah. Just because something's removed does not necessarily mean scores go up. That's another huge mistake out there that people don't know and don't talk about it.
Yeah.
If I'm not building positive, building better credit, scores can still remain low. If I'm not managing my debt correctly, scores could still remain low. I mean, there's so many different variables.
And we see it all the time.
Yep.
And a lot of times people will look at me and it's like, so I'll pull a credit report, I'm doing a pre-approval for a mortgage, and someone will be, hanging around a 660 or 670. It's like, well, what can I do to get my score up? And I'll be looking through there. Most of the time, it's if there's any sort of a quote unquote quick score deal, it's usually paying credit card balances
debt reduction,
down, right? And so I teach them how that works, and don't make your payment after your billing statement comes out. Make a payment before your billing statement comes out, so that the lower balance actually reports in your credit report, and all these tricks that we do. And a lot of times we'll be like, well, what if I'll just pay my auto loan off then, or now I'll pay this other installment debt off, I'll pay the student loan off, do all that stuff, that should raise my credit score, right? And I'm like, yeah, probably not.
Nope. That once again won't work very effectively.
Installment debt works different than credit card debt, and so it's like installment debt. Once you pay that off, that account's closed now. It doesn't.
We're
stay
missing
open.
out on that payment history, and there's a term in FICO called rank order risk. Higher the loan balance, the more important it is. A lot of times, certain installment debts, auto loan, mortgage, student loan, their ranking is higher because that balance is typically higher. So you want positive payment history on an account like that. So like if you paid off early, and once again, for the purpose of improving credit scores right now, it's not going to help you.
Yeah.
You know what I mean? But what you said on the credit card side, yes, because that's a separate portion of the algorithm and how they calculate risk. Yeah, the management of that is very different. And so, in that case, you would want to reduce that and it may have lower balances reporting.
You might be in a position where paying off your auto puts you in a better buying position because your credit's strong enough that closing that account, that's fine. It's not going to rock the boat too much. Yeah, your credit score might go down a tiny bit, but it's going to free up some income as far as what you qualify for and so on. And so that's why it's good to take a look at this stuff before you start making moves and decisions.
Literally just making your credit card payments on a different date can swing your score. I had one guy that swung a score 83 points because he had one open credit card. He charged everything for the month on that credit card. He waited for the balance statement to come out at the end of the cycle, and then he would make a full payment on it. So it was a $4,000 card. He'd show a $3,500 balance on it every single month after month, even though he paid it off in full. What was reported on his credit report was, hey, your last statement said there was $3,500 on it, so now there's $3,500 against a $4,000 credit card there. And so because he had limited credit, basically his entire score was run off that one credit card that he had. I said, look, do the same thing, but make your payment 3 days before the cycle ends. So that payment clears and your balance gets knocked down to zero. So the next month he did that. His score went up 83 points.